These 7 tax write-offs will reduce your individual taxes instantly, and all you have to do is watch this video until the end for all of them. Now, these are the same tax write-offs that I use to save my clients thousands of dollars in taxes as a licensed CPA at mycpacoach.com, and now I'm going to share them with you for free. So let's jump right in. All right, so first and foremost, what exactly is a tax write-off? Well, put very simply, this is just a tax-deductible expense that lowers the income that we report on our tax return. So the more tax write-offs that we have, the less income we will report or show when we file our return. And we know the less income we report, the less taxes we will pay. Or if you typically receive a refund, then more tax write-offs will only make your tax refund even larger. So let's illustrate how this works with the simplest and easiest to understand tax write-off. Number 1, the standard deduction. Now, this deduction grants individuals an immediate tax write-off and is entirely based on your filing status. And as of 2025, the standard deduction is $15,000 for single tax filers or $30,000 for married filers filing jointly, and $22,500 for head of household filers. So let's illustrate this with an example. Let's say you are single and you have $100,000 in total income in 2025. Well, in that case, the standard deduction amount of $15,000 would lower your taxable income to just $85,000, and you would only pay tax on that $85,000. And if you are in, let's say, a 22% tax bracket, for example, then you would save about $3,300 in taxes from using the standard deduction alone. And that's how powerful tax write-offs are, and also why we want as many tax write-offs as possible. So let's go ahead and talk about the next big individual tax deduction here. Number 2, the itemized deduction. Now, for some individuals, the itemized deduction may be more beneficial for them than taking the standard deduction. And if so, you can make a costly mistake by not selecting this deduction when you file your tax return. So the tax law allows you to take either the itemized deduction or the standard deduction, not both when you file your return. So let's make sure you fully understand which of these options may be best for you so you can pay the least amount of tax possible. So unlike the standard deduction, the itemized deduction allows you to write off certain expenses that you paid for as an individual, such as medical and dental expenses that exceed over 7.5% of your income, or up to $10,000 of state and local taxes, which may also include your property tax. It also allows you to write off any mortgage interest expense that you paid, any gifts you made to charities, and any casualty and theft losses. And if the total value of these expenses exceed your standard deduction, then that would simply mean that the itemized deduction would save you more money in taxes when you file your tax return. So as a general practice, before you file your tax return, you will want to look at all of your itemized expenses and measure it up against the standard deduction to see which saves you the most money in taxes. But we're far from done here. In addition to taking either the standard or the itemized deduction, there are far more things that you can write off as an individual. So let's talk about those write-offs as well. Write-off number 3, the IRA deduction. So if you move money into an individual retirement account or IRA, then you may qualify for a tax deduction equal to the amount that you put into it. And a lot of people think that IRAs are business deductions, but they are not. You can set up an IRA as an individual for free at most places and take this deduction on your individual tax return. So here is how it works. In 2025, you can put up to about $7,000 into your IRA or $8,000 if you're above the age of 50. And if the account is set up as a traditional IRA, then your contribution would be 100% tax deductible. But that's if you are also not covered by a workplace retirement plan, like a 401k, for example, at your job or business. And if you are, then there are certain income limitations that you should be aware of that may impact your ability to take the IRA deduction, which varies based on your filing status and whether or not you or your spouse is covered by some type of workplace retirement plan. And if you are covered by a 401k plan, for example, you should also know that those contributions may also be tax deductible. So let's address number 4, the 401k deduction. So if you move a portion of your earned income into a traditional 401k plan, then that portion of your income would not be subject to tax and would reduce the income that you report on your tax return for that year. For instance, in 2025, you are able to put up to $23,500 of your wages into your 401k plan, or over $31,000 if you're above the age of 50. And individuals between the ages of 60 and 63 can actually put about $35,000 of their income into their 401k. So if you took advantage of something like this, then it would allow you to write off every dollar that you put into your traditional 401k account up to the maximum individual limits here. And usually to take this write-off on your tax return, this amount is either automatically applied to your W-2 that you receive from your employer or business, and if not, then you may be able to apply the deduction elsewhere on your individual tax return. Now let's talk about number 5, the health savings account tax deduction. Now, this is another write-off that a lot of people think only applies to business owners, and to be fair, they can be, but you can also set this up for free on your own as an individual without any type of company account and deduct this on your individual tax return. So let's talk about how this deduction works. So basically, you are entitled a tax deduction for every dollar that you put into a qualified HSA plan up to the maximum limit. You can put anywhere from about $4,300 to $8,500 into an HSA depending on your filing status and your healthcare plan. And when you do, you typically receive 3 types of tax benefits. Number 1, you will get a tax deduction for the amount that you put into your HSA. And then number 2, when you invest the funds into assets inside of your HSA account, into things like stocks or bonds, those gains are also tax exempt at that time. And then number 3, when you spend money on qualified health expenses, then those funds come out of the account tax free. Now let's talk about number 6, self-employed tax deductions. Now, with nearly 50% of Americans having a side hustle, millions of taxpayers qualify for additional tax deductions without even realizing it most of the time. So when you earn non-employment income, like 1099 income or income that is not taxed under a W-2, you can qualify for certain tax deductions under Section 162 of the Internal Revenue Code, which basically states that you can write off all ordinary and necessary expenses in carrying on any trade or business. And this basically allows you to write off all expenses you incur to earn non-employment income, whether it be through a 1099 or ordinary business under Schedule C of your individual tax return. But even better than that, this provision also allows you to write off the business use of any personal expense that you incur, like portions of your home expenses, dining expenses, transportation costs, travel, health insurance, and so on. So if you earn this type of income and think that this may apply to you, then make sure you also check out my video on the top business tax write-offs as well to help you save even more money in taxes. Now let's talk about number 7, the student loan interest deduction. So if you are one of the 45 million taxpayers that have student loan debt, then you definitely do not want to miss the opportunity to write off your student loan interest. Now, this deduction allows you to write off up to $2,500 of your student loan interest expense, even if you don't itemize deductions on your tax return. But that's only if you report less than $75,000 in income as a single taxpayer or less than $155,000 as a married taxpayer after accounting for all of your tax deductions. And if you do and are still incurring education expenses, then you may also qualify for other tax breaks like the American Opportunity Tax Credit, which grants another $2,500 in tax benefits as tax credits that directly offset your tax liability for the first 4 years of higher education that you have. And if that doesn't work, you may also want to look into the Lifetime Learning Tax Credit, which does not cap the amount of years that you can take the credit for and can be used for a broader range of education expenses. And that tax credit will provide you with up to $2,000 that can be used to offset your tax liability. And these are just some of the relevant tax credits out there. There are several more tax credits out there that vary based on your circumstances and your income, like the Earned Income Tax Credit, the Child Tax Credit, the Adoption Tax Credit, and so on. So just drop a comment below if you would like me to cover any one of these topics in greater detail, or if you have questions about the individual write-offs we've covered in this video. And if you happen to pay a lot of money in taxes and need help reducing it, like right now, then just apply to work with one of my CPAs today at mycpacoach.com.